Zscaler finds itself at the center of an AI driven identity crisis in cybersecurity. Zscaler has become one of the most hotly debated names in the technology sector as investors, analysts, and industry practitioners wrestle with a deceptively complex question. Do rapid advancements in artificial intelligence, exemplified by tools like Claude Code and next generation AI security platforms, represent an existential threat to established cybersecurity firms? Or do they actually deepen the structural need for the very solutions companies like Zscaler provide? The debate has intensified following a series of notable sell offs in ZS shares, which have rattled confidence among retail and institutional investors alike. Some market participants fear that AI native security tools could commoditize or outright replace the layered, enterprise grade solutions that have historically been Zscaler's core value proposition. The argument goes that if AI can autonomously detect, respond to, and neutralize threats in real time, potentially at a fraction of the cost, then legacy security architectures, however sophisticated, could quickly lose their pricing power and competitive moat. For a subset of the investing community, this fear has translated into aggressive selling, with some voices raising the more dramatic specter of potential delistings or severe multiple compression if the narrative solidifies. However, a vocal and arguably more analytically grounded contingent pushes back firmly against this bearish framing. These observers contend that the panic reflects a fundamental misreading of both the technology and the macro threat environment. Their counterargument centers on a key insight: AI doesn't just defend networks, it also attacks them. As AI tools become more accessible and powerful, threat actors gain the same capabilities that defenders do, arguably faster and with fewer resource constraints. The result is an exponential expansion of the attack surface, with more sophisticated phishing campaigns, autonomous malware, AI generated social engineering, and zero-day exploitation occurring at machine speed and scale. In this environment, the argument goes, the demand for robust, enterprise wide security infrastructure doesn't diminish, it accelerates. This is where Zscaler's zero trust architecture becomes particularly relevant. Unlike traditional perimeter based security models that assume anything inside the network can be trusted, zero trust operates on the principle of never trust, always verify. Every user, device, and application must continuously authenticate and earn access, regardless of where they sit relative to the corporate network. Proponents argue that this model is uniquely well suited for the AI era, where threats can emerge from within an organization just as easily as from outside, and where the sheer volume and velocity of access requests demand an intelligent, policy driven framework rather than static firewall rules. For this camp, the recent sell off represents not a rational repricing of Zscaler's fundamentals, but an emotionally driven overreaction to AI hype, one that has created a compelling buying opportunity in an oversold name with durable, long cycle demand drivers. They point to Zscaler's expanding platform, its deep integration into enterprise workflows, and its growing role in securing hybrid and multi cloud environments as evidence that the company is not a relic of a pre AI world, but a necessary pillar of any AI ready security posture. Ultimately, the Zscaler debate is a microcosm of a broader question the market is struggling to answer. In a world where AI is simultaneously the most powerful offensive and defensive tool in cybersecurity history, which companies are disrupted and which become indispensable?
Okay, so the stock is down 8 point, roughly 9%. This is Monday, the 27th of the 23rd of February 2026. The stock has been showing a lot of weakness within a longer term bearish trend. It's 200-day moving average, this one, which underscores its underlying trend, as you can see, sloping bearishly lower. Yes, been contracting and printing lower prices all the way back to, let's see now, this looks like when? November? Yeah, early to mid November. That's when its own case began. At various times attempting to bounce, but we have seen initially the 10-day moving average was a primary supply line. It improved and well, if it makes it any better, the 20-day moving average became one as well. It went from being the 10-day moving average went from the primary supply line. We have this case here, meaning that if it closed within one standard deviation, selling pressure ensues. Okay, increases. Okay, we have here 25th of November here, 10th of December, a couple of them here from late December. Yeah, late December, Boxing Day, and then suddenly changed. Now became it got stronger, and the 20-day moving average, 21-day moving average became one, became primary supply line. That is, if it gets there, closes within one standard deviation, you see selling pressure. We have here 7th of January and 27th of January, and now it has come back to the 10-day moving average. Is getting worse of late. So lower prices are expected to continue to print at least up till the 9th of February. This is the up to 10th of February, 10th of March. Okay, the 40-day moving average is equally continue is expected to continue to decline to prevent any possible expansion. There's no bottom in sight. 167 is the upper projection. It's currently trading at 145.60. Let's see what we have on its price pressure momentum for its 10-day moving average. Let's see. We want to see how stable or the lack thereof things might be. Okay, so volatility is expected to remain in place at least up till the 5th of March. Yeah. Okay. Yeah. I think it's up to 5th of March. Maybe may begin to see some stability from the second half of March. There's no guarantee that will be the case. Yeah, we can see here it's expected to remain get a lot more stable, but with some volatility as well. Okay, let's have a look. This moving average is gaining or losing is losing $1.27 every day. Okay, that's not yeah, not fantastic. Positions opened 10 days ago are not in profit. Okay, let's see what we have for its 40-day moving average. I mean 21-day moving average. Okay, yes, it's losing $1.598. Okay, it's expected to remain stable. Some stability is expected to kick in from the 27th of February. Yeah, but still volatile, but a lot more stable. A lot more stable. But it's not. I don't think I don't think we have any indication that we might see a bottom yet. At some point, a bottom might print. It may be re-rating. Yeah, maybe re-rating. It may be contracting to continue to trade at lower prices. I mean, if fundamentals are still okay, nothing has really gone wrong. Just the market is perceiving that their margins would have maybe eroded, may get eroded. But it's with time, we'll see who is going to win the argument. You know, here we have the 10-day moving average. Just the let's see. Yeah, the 40-day moving average volatility is expected. So for some reason, the 21-day moving average is expected to be a lot more stable than the 40-day moving average. Maybe a couple of things might happen between now and then, and maybe yeah, mix things up. Okay, let's see what we have on its 200-day moving average. Yeah, no stability with no stability at all. It's only for some reason the 21-day moving average is expected to remain more stable between now and early April. Okay, so let's see now the probability of it retesting this projection here of 167 is statistically higher than 50%, but you can't rely on that at all. You can't rely on that. So yeah, that's what's going on. Zscaler is trending lower prices. Expect to continue to print, no bottom in sight. Let's see what we have on its weekly chart. Okay, no extrapolations here. It doesn't have enough data. Projections are saying 243.05. It was initiated on the 15th of December, still being reiterated up till today. Okay, so see what you make of Zscaler, and thank you very much for watching this video.